Hello and welcome to Pro Trader Strategies market commentary for Wednesday, December the 11th. My name's Eric Wilkinson, and yes, you very well may recognize me as the Wolfman from mainstream media. And in mainstream media, I was talking about economic data, how that implicates, what those implications are on the markets and the overall economy's health and well-being for the most part. I do that in these daily market commentaries as well. I go over the economic data, how we see that impacting these markets, and then on top of that, talk about trade ideas that we can take options and implement those options into our portfolios in any given way. All right, I also have specific rules in and around those option strategies. It's not just taking a bullish strategy and buying calls and taking a bearish strategy and buying puts. It's a little bit more in depth than that. All right, we have some finite rules that we follow in order for each strategy in and around any given underlying and or environment. All right, and for that matter, any assumption. All right, so without further ado, let's get on with the overall economic data. But first off, please remember past performance of any trading system or methodology is not necessarily indicative of future results. All right, across the pond, not a whole lot to see there. Today is a big day here in the United States, though. One thing we do have is the FOMC statement and their rates, what we are going to do with rates here. It's at 1.75, expected to stay at 1.75. I don't think that they are going to increase or decrease interest rates anytime soon. One thing to note, though, they are going to be looking at a lot of different segments of the economy in order to follow their mandate. And one of that is, the growth, the GDP, which is actually a little bit below what their mandate is. So some are speculating that in 2020 we might see more rate cuts. I don't know if we're going to really see that just yet, with growth right around a little bit better than 1%. We're at 1.75 in the Fed funds rate. They want to kind of match that. So that would indicate about a 50 basis point cut, in 2020. I don't know if we're going to see that just yet, but we'll have to see what their statement says. Anyway, on with our economic data, we got CPI, which is Consumer Price Index. That's what you and I are paying, and it came in at 0.3%, expected to be at 0.2%. Now, when we strip out food and energy, we get 0.2%, and this is the core CPI, and it was expected to be 0.2%. So what can we take from that? Well, food and energy is driving this consumer prices higher. Now, I've talked about this time and time again. Those aren't necessarily the sectors we want to see driving prices higher. It is the more volatile aspect of that data point, which is why we look at it with stripping that number out. But food and energy, food is the staple we got to use, and, those prices fluctuate. But the energy aspect of that is what I don't want to see driving prices higher. And I've talked about this time and time again because that decreases velocity of money. And we want to see that velocity of money, especially in an economy where it is struggling here and abroad. We'd rather see energy prices come down so that we can spend those extra dollars elsewhere. All right, we also got crude oil inventories. Remember, last week we saw a huge drawdown. That's been the catalyst of this move higher in crude oil, which is the chart that I have up right here. And with that drive higher in crude oil, we saw today the build. So it was expected to be a drawdown of almost 3 million barrels, 2.9 million. So let's just call it 3. It had a build of 0.8 million barrels. So 800,000 build. So much bigger build than what was expected. That's why we're seeing this little bit of a drop here back below $59 a barrel, just albeit slightly. We were testing that $60 a barrel. I've talked about time and time again, check 60. And then today with that weakness, we broke back below $59 a barrel, which is this red line right there. Let me find a better pen. $59 a barrel right there. So that's that line in the sand. Now came down and tested the $58 a barrel, which is this yellow line right here. Let's just draw it a little bit thicker. That's $58 a barrel. And you've heard me talk about this. The point of control, which is right here, This is the point of control. That's where the most time and volume has been spent. That's lining up with $56.50 a barrel. You know, back below this $58 a barrel is really where we see gasoline prices go below $3 a gallon. Now that's where we would like to see that stay, you know, as an average, staying below $3 a barrel. You know, it doesn't seem like that much, but when you talk about every time you fill up your tank and it's, you know, $2.50 or $3 total less, well, that $3 or $5 gets spent elsewhere in the economy, okay? And that's really where we see that money create that velocity money, because usually that extra $3 to $5 is spent in those communities in and around where you live. And then that helps out the small businesses. The small businesses then start spending that also in and around that community that you live in. So 80% per dollar of that would be spent within and kept within those communities in and around your home, which really is the driving force around the economy. All right, enough about all of that. Let's get on with the overall markets. You can see here, we've talked about it, crude oil breaking down. I'd like to see it break below this Fibonacci right here, which is lined up with $58 a barrel. That would be good for us going forward. Especially heading into a holiday season. You know, $5 is a nice stocking stuffer for your kids, right? That's where we're talking about creating that velocity of money. If that $5 goes into your tank, nobody sees it. Anyway, we've got gold futures moving higher again today. We're seeing a mixed bag in the equities as all of this stuff with China is going back and forth. The impeachment is still overhanging. Also, a lot of people going to be covering some of their positions ahead of this FOMC statement, which comes out later on today at 1 o'clock. It's actually 2 o'clock Eastern, 1 o'clock Central, and 12 o'clock here where I am for the most part. All right, so gold futures moving higher. People are going to be putting their money away, safe haven, if you will. Bond prices driving a little bit higher by about a half a point. I've talked about this. I think the market's going to drive back towards those 160s. I think the FOMC statement is going to be a little bit dovish, despite the fact that we saw that great number with the unemployment number last week. I think that the Fed is still going to be a little bit more dovish. There's several sectors of the economy that are the Rust Belt isn't doing that great, so that's something that they are going to be concerned with as well. But we're seeing bonds move a little bit higher, taking out some of those higher yields we saw yesterday. All right, VIX unchanged on the day, and that's basically because we do have a mixed bag at any given time with, say, the Dow Jones Industrial Average down about 35 points on the day. It is still above that 9-day moving average. Remember, we've talked about the 9-day moving average. It shows short-term directionality. Here's the 9-day in blue. So we can see that we're still above that. It's tested it. It's acting as support, you guys, right now. So the market is still, even though we've had several days of downtrend here, we are above that. That is short-term bullishness going forward. So today we are still able to stay above there. And I believe that the FOMC statement is going to be the real determining factor. If they start acting a little bit more hawkish, which means interest rates rising, then I think that you'll see the equities throw a bit of a tantrum, meaning going to the downside. If they start talking a little bit more dovish, then I think that you're going to see the equities respond to the upside. Here we have the NASDAQ now on near, or at least near, the highs of the day, up 20 points, 21 points. That's where I'm talking about this mixed bag in equities. That's causing the VIX to kind of stay middle of the road, almost unchanged. Dow's down, VIX, Dow's down, VIX should spike, but now we see the NASDAQ higher, which causes the VIX maybe to come off a little bit there, all right? So NASDAQ in positive territory, and E-mini S&Ps up 1, but we could call that unchanged. We could see that raced in a matter of seconds. Again, above the 9-day moving average, which is short-term bullishness in the markets, all right? And then Let's look at the E-mini S&Ps. This is a 30-minute candle chart. Gray areas overnight. Day session is in black. We are finding a bit of a bottom here today after we saw some really bearishness coming into the market today after the open. Nothing really to see there other than I think that the overnight inventory was relatively long and we got flushed out on the open, which is a healthy sign. Inside day, I think you'll probably see that for the remainder of the day as a pretty tight market, lower than normal volumes. Not only because we're heading into a holiday market, which we will generally see those volumes come off a bit, but also as people are hedging up their positions, if they haven't already done so in the past few days ahead of this FOMC meeting, then I think that we will see this really kind of slow down and be a little bit more lethargic heading into that meeting. And then let's talk about a couple of other things that we were looking at. Disney, you guys know I did the synthetic long on Disney based on their new streaming. It's actually supposed to add about $20 million in revenue to Disney year over year just on this streaming aspect. Now, I was talking in the past about Netflix really suffering from that. Well, one of the things that we saw out of that Disney streaming subscription model for all of their Disney products, or Disney movies and Pixar, well, Netflix, I was expecting to see a little bit more pullback as people would cancel maybe Netflix for the Disney because those are movies as well, right? Well, we didn't really see that. Maybe a bit of a dip, but it didn't really look like people were canceling their subscriptions and going to Disney and maybe Hulu, where Hulu is more streaming TV and, you know, TV movies, or made for TV movies where they edited in commercials and edited out the bad stuff. Well, Netflix didn't seem to really be affected by that. I was looking at doing a synthetic short on Netflix, but now I'm kind of leaning towards Boeing. You know, join me in this webinar on Thursday because we are going to be throwing it out to you guys. I'll look at some of your guys' bearish assumptions and see if we can build the strategy around that. I might very well pick what you guys throw out there. So join me in that. It is very open forum, back and forth throughout the entire webinar. You guys drive some of that content, so make sure that you check that out at protraderstrategies.com. So I'm going to either be, at this point, picking either Netflix or Boeing for a synthetic short. I'll talk about all the rules in and around how we build that out and why it is more beneficial than just going out there and shorting it on the platform, okay? So we'll use options to create that short strategy, all right? And that's about it. Other than, you know, I hope you guys all have a great day. Keep your eyes out for the FOMC. And if you can't take that, take it easy.